In 1943, one man told Congress a secret about your money, and it worked exactly the way he said it would. He was right. You stopped noticing it was gone. Right now, somewhere in America, someone is calling that same money a bonus, when it was hers all along. And the man who started it walked into the United States Senate as a nobody and rewrote how 150 million Americans would feel about their own paychecks. New York City, January 1943. Inside a radio studio on Madison Avenue, a heavy-set man in wire-rimmed glasses leans toward a CBS microphone. He is not a senator. He is not a president. He is a department store treasurer, and in 3 months, he will change the American financial history of taxation forever. That CBS interview will start a chain reaction ending, 83 years later, in your bank account. Here's the part nobody says out loud. You've probably felt a small thrill every time a refund check lands. A little windfall. Free money almost. It isn't free. It was never free. It was yours. Sitting in the Treasury's hands for up to 12 months, earning you nothing. According to IRS filing season data, the average tax refund in 2026 climbed to roughly $3,521, and nearly 72% of filers received one. That's not generosity. That's overcollection, corrected months later, dressed up as a gift. You didn't choose this system. Nobody your age was in the room when it was built. And that's the first open loop worth sitting with. Why does a government designed to take your money currently also get to decide when you notice it's gone? There's a second question waiting underneath it, one this video will answer with names, dates, and documents. Is there anything you can actually do about it, today, for free, without hiring anyone? To understand both, we have to go back, past your parents, past your grandparents, to a marble hearing room in Washington and a plan almost nobody remembers by name. A plan almost nobody remembers by name, but everybody lives inside. Rewind to 1913, the year the federal income tax was born under the newly ratified 16th Amendment. For nearly 3 decades after that, paying it looked almost nothing like it does now. You earned your money all year, and then, the following spring, you wrote one enormous check to cover it. No withholding, no paycheck deduction. Just a single brutal reckoning every April. For most of that era, it barely mattered. Income tax touched a small slice of the country, mostly the wealthy. It was, for most working Americans, a piece of economic history that simply didn't apply to them. But then came December 7th, 1941, Pearl Harbor, and with it, a war that had to be paid for, not by a few thousand high earners, but by the country as a whole. Here is the number that explains everything that follows. The pool of Americans required to pay federal income tax grew more than 7-fold in just a few years. Millions of factory workers, clerks, and shopkeepers who had never filed a tax return in their lives were suddenly on the hook. And the old system, the once-a-year lump sum system, was not built for them. Ask a worker earning wages week to week to save up an entire year's tax bill, and you get exactly what Washington feared: mass default, mass resentment, and a fragile wartime treasury. The Treasury Department knew it had a problem, and it wasn't alone in trying to solve it. Early in 1943, the U.S. Chamber of Commerce floated its own proposal. Let taxpayers defer their 1942 taxes for 5 to 10 years after the war ended, while a new 20% withholding tax applied only to current income going forward. Treasury officials, for their part, offered several competing plans of their own: postponement schedules, partial forgiveness formulas, staggered payment structures. None of them captured the public's imagination. All of them assumed Americans would tolerate a complicated, gradual transition into the new financial system. Beardsley Ruml assumed no such thing. Enter Beardsley Ruml, not a senator, not a Treasury official, a private citizen, treasurer of R.H. Macy & Company, and chairman of the Federal Reserve Bank of New York. On July 27, 1942, Ruml walked into the Senate Finance Committee with an idea he called pay-as-you-go, Collect the tax the moment the income is earned, he argued, a little at a time, automatically, out of every paycheck. But Ruml knew a plan alone wouldn't sell itself. Switching from pay last year's tax this year to pay this year's tax this year created what tax historians call the doubling up problem. Americans would effectively owe 2 years of tax in a single year. So Ruml paired his mechanism with a promise. Forgive the old liability. Cancel it. Wipe the slate clean and start fresh under the new system. It worked exactly as he calculated it would. On August 24, 1942, a Senate Finance Subcommittee voted unanimously to support the plan. Forgiveness included. According to Ruml's own CBS radio remarks that January, he considered withholding collection at the source, a mechanism, in his words, that simply made it easier for people to keep on a pay-as-you-go basis. Financial history rarely turns on a single radio interview. This one did. It's worth pausing on why the Chamber's version never caught fire the way Ruml's did. The Chamber's plan asked Americans to wait years for relief and accept a brand new tax on top of what they already owed. Ruml's plan asked for nothing. It simply erased the old bill and asked people to start clean. One version required patience. The other offered a party. Politically, in the middle of a war, there was never really a contest. Not everyone found it so simple. President Roosevelt's own treasury pushed back hard, calling full forgiveness unnecessary, inequitable, and inflationary. A windfall for wealthier taxpayers riding out the war on paper losses. Eleanor Morgenthau, wife of the Treasury Secretary, put the objection even more plainly in private conversation, calling forgiveness a betrayal of any philosophy that refused special treatment to the wealthy. It was, at its core, an early skirmish in a much longer American argument about wealth inequality, one that would outlast the war, outlast Ruml, and outlast almost everyone in that hearing room. The fight dragged through Congress for nearly a year. On May 4, 1943, the House passed a compromise version forgiving 60% of old liabilities, 313 to 95. 10 days later, the Senate went further, backing Ruml's fuller plan outright, 49 to 30. Ruml, for his part, never treated the political fight as a battle he might lose. Trained originally as a psychologist rather than an economist, he had spent years studying how ordinary people actually respond to institutions, not just how policy briefs assume they should respond. That background shaped everything about his pitch. He wasn't selling Congress on an accounting method. He was selling the country on a feeling. Relief, first. Mechanism, second. And betting correctly that the feeling would carry the policy across the finish line, even over the objections of the president's own treasury. Roosevelt was furious. He wrote to congressional leaders that full cancellation would produce, in his words, a highly inequitable distribution of the cost of the war, enriching upper-income taxpayers at everyone else's expense. A compromise finally emerged. The House passed it 257 to 114 on June 1st. The Senate followed, 62 to 19 the next day. On June 9, 1943, Roosevelt signed the Current Tax Payment Act into law. It forgave 75% of the lower of a taxpayer's 1942 or 1943 liability, and it installed, for the first time in American history, automatic withholding at the source. Ruml got his mechanism, the country got its forgiveness, and an entire generation of Americans got something else almost by accident. A permanent invisible habit of never quite feeling their own tax bill again. That habit is still running. What Ruml actually built wasn't just a collection system. It was a piece of psychology, engineered, tested, and signed into law. And it's still sitting inside every paycheck you've ever received. Every paycheck you've ever received. Sit with that for a second, then picture something smaller. Layer 1. Before 1943, paying taxes felt like this. A single roll of coins, all at once, handed over in one heavy motion. You felt the weight leave your hand. You noticed. After 1943, paying taxes felt like this instead. One coin quietly out of every transaction all year long, so small, so constant, that your hand stops registering the loss at all. That's the entire trick, not the amount. The feeling of the amount. Layer 2, the actual mechanism, the one written into the current Tax Payment Act of 1943, and still operating in every American payroll system today. Your employer is legally required to estimate your annual tax liability, divide it, and deduct a portion from every paycheck, automatically, before the money ever reaches your hands. You never touch it. You never decide to send it. The transaction happens without you. The instrument that makes this possible sits in almost every new hire folder in the country. The W-4 form. Fill it out once, and you've handed your employer a formula, filing status, dependents, additional income, that the payroll system runs every single pay period, silently for as long as you hold the job. Change nothing, and the formula keeps running, year after year, on assumptions you made once and probably never revisited. That's not a flaw in the financial system. That's the financial system working exactly as Ruml intended it to work. Quietly, by default, without your ongoing attention. Here's the twist almost nobody expects. This system was never primarily about making sure the government got paid. Ruml said so himself on the record to Congress. The Treasury would collect, in his words, substantially the same amount either way. Old system or new. The money was always going to arrive. What changed wasn't the total. What changed was who felt it, and when. Layer 3. The scale, in real numbers. Before the shift, income tax reached a relatively narrow slice of the country. According to Treasury Department accounts of the period, the number of individual taxpayers grew more than sevenfold in the space of a handful of years, as the wartime tax base expanded to include most working Americans for the first time. Withholding wasn't a footnote to that expansion. According to tax historians who have studied the period, it was the load-bearing wall, the only mechanism that let a government now taxing tens of millions of paycheck-to-paycheck workers actually collect from them without triggering mass default. Scale it up further, and the picture gets sharper still. Today, the Internal Revenue Service processes well over 100 million individual returns in a typical filing season, a volume the pre-1943 lump sum system was never designed to survive. Withholding isn't just a convenience at that scale. It's the load-bearing wall of the entire modern financial system, the mechanism that makes it possible to tax an economy of this size without asking a single household to save an entire year's liability on their own. Pause here. Look at your own most recent pay stub, right now if you have one nearby. There's a line on it, usually near the top, that says something like, Federal Income Tax Withheld. That line is Beardsley Ruml. That line is a 1943 hearing room. That line is 83 years of how money works, compressed into 6 words on a piece of paper you glance at for 2 seconds and forget. You now know what happened, and roughly how. What you don't know yet is what it costs you, not in abstract history but in your actual present-day bank account. And that's where the story leaves 1943 behind entirely, and walks straight into this year's filing season. This year's filing season starts, fittingly, the same way 1943 did, with a mailbox. Late winter, 2026. Across the country, tens of millions of envelopes like this one are landing on kitchen tables. According to Internal Revenue Service filing season statistics, the average tax refund this year climbed to roughly $3,521, up several $100s from the year before, and about 72% of processed returns resulted in a refund at all, the highest share in at least 5 years. Here's what most coverage of that number leaves out. According to policy researchers cited in that same reporting, the jump wasn't a gift from Washington, it was a mismatch. New deductions took effect for 2025, but employer withholding tables hadn't caught up. Millions of paychecks kept deducting at the old, higher rate for months. The Ruml mechanism, collect first, reconcile later, did exactly what it was built to do in 1943. It just did it with new numbers. Nearly 83 years after the current Tax Payment Act, The Treasury Department is still running Beardsley Ruml's core design. The Internal Revenue Service still calculates your bill in arrears. Your employer still deducts automatically before you touch a dollar. And when the reconciliation finally happens each spring, the surplus comes back to you framed, culturally, emotionally, as a bonus rather than what the mechanism actually produced. Your own money, held without interest, for months you'll never get back. It's worth remembering, resistance to this exact arrangement is almost as old as the mechanism itself. When withholding first appeared decades earlier for narrower purposes, employers and financial institutions objected loudly to the administrative burden of collecting someone else's taxes for the government. Even Ruml's own plan faced a full year of congressional resistance before passage. Roosevelt's Treasury fought the forgiveness provision specifically because it saw the political sleight of hand for what it was. The instinct to question this system isn't new, it's simply been quiet for a long time. The 2026 filing season carries its own version of that old argument. This year's larger refunds trace back to sweeping tax law changes enacted the previous summer. New deductions for tip income, overtime pay, older taxpayers and auto loan interest, along with a much higher cap on state and local tax deductions, raised from $10,000 to $40,000 for filers who itemize. According to Treasury Department figures, more than 27 million returns, nearly 45% of filings, claimed at least one of these new provisions by early March. Employers simply hadn't reprogrammed their withholding tables fast enough to keep pace. The result was the same story Ruml understood in 1943, replayed in a different decade with different line items. The system collects first and only reconciles later, whether the mismatch runs in the government's favor or this year in yours. So here's the mechanism question, finally answered in full. Why does the government get to decide when you notice your own money is gone? Because in 1943, one man convinced Congress that a country of new taxpayers couldn't be trusted to save for a once-a-year bill, and the fix he offered didn't just solve a collection problem. It quietly rewired how tens of millions of people would feel about their own income permanently. The mechanism question is closed. The solution question, what you can actually do about it, is still ahead. And it starts with a name and a number you're about to meet. A name and a number. Here's the name. Maria, 34, sits down at her kitchen table on a Tuesday morning in March, watching a number load on her screen. $3,890, her refund. She lets out a breath she didn't know she was holding, the kind of relief that feels for a second like winning something. She didn't win anything. She lent it. Maria works in marketing, salaried, paid bi-weekly. Nothing about her situation is unusual. Her employer withholds a set percentage from every check, calculated from a W-4 she filled out 4 years ago, and hasn't looked at since. She didn't choose this year's number. Nobody sat her down and asked whether she'd rather have that money now, in 26 smaller installments, or later in one lump sum with no interest attached. The choice was made for her, by default, the moment she signed her hiring paperwork, and by a mechanism designed decades before she was born. Go back to 1943 for a moment, to a case documented in the era's own congressional testimony. Recently retired workers, people living on modest pensions after decades of employment, found themselves owing a full year's tax bill calculated on their old, higher wages, with no way to pay it out of their now smaller income. According to the historical record cited by tax historians, that exact hardship was part of the argument Ruml made for his forgiveness plan, a real human problem, used to build political support for a mechanism that would go on to shape the country far beyond that one hardship. Maria's version is smaller, quieter, and repeated tens of millions of times a year. According to the same 2026 IRS filing season data referenced earlier, the average refund now sits above $3,500, money that sat, unpaid to her, for up to 12 months, growing the government's short-term cash position instead of hers. At even a modest savings return, economists estimate that kind of overpayment can cost the average filer somewhere in the range of $100 a year in quiet, invisible opportunity cost. Not a fortune, but not nothing. Repeated year after year, paycheck after paycheck, by nearly 3/4 of the country. Maria isn't angry, watching that number load. She's relieved. That's the part worth sitting with. Not that the system takes too much, but that it's built so well, so quietly that being repaid your own money still feels like good news. That feeling isn't an accident of personality. It's 83 years of design working exactly as intended. 83 years of design working exactly as intended. Here's how you push back against it, starting today for free. None of what follows is a workaround, or a loophole, or advice to skip. It's the same tool Ruml himself pointed to in 1943. Adjustment at the source. Turn to work for you instead of just for the treasury. Step 1. Check your withholding. Every W-2 employee in the United States has the legal right to adjust their federal withholding by submitting a new Form W-4 to their employer at any time, as often as circumstances change. This isn't a gray area maneuver. It's built directly into the same system Ruml helped create. Step 2. Use the free federal tool built for exactly this. The Internal Revenue Service publishes a tax withholding estimator on IRS.gov, free to any taxpayer, no account required. Run your numbers once a year, 5 minutes, no cost, and you'll know whether your paycheck matches your actual liability or whether you're still quietly overlending the government your own income. Step 3. Reframe the refund itself. A refund isn't a bonus. It's confirmation of a math error, one made in your favor, but a math error nonetheless. That single reframe, historians of behavioral economics note, is often enough to change how people approach their own withholding going forward. Step 4. If your income varies, freelance, self-employed, gig work, understand estimated quarterly taxes. The financial system built in 1943 assumed steady paychecks. If yours isn't steady, the IRS requires estimated payments 4 times a year instead of automatic withholding. The direct descendant of the exact doubling up problem Ruml wrestled with 83 years ago. Knowing that requirement exists and planning around it prevents the kind of penalty surprise that mechanism was never designed to protect you from. There's a version of Step 4 worth naming directly for anyone affected by this year's changes specifically. If you claimed a new deduction for tips, overtime, or SALT under last year's tax law, your withholding almost certainly hasn't caught up yet either. Which means the same mismatch driving this year's larger refunds could still be sitting, uncorrected, in your paycheck right now. A 5-minute check with the free federal estimator resolves that uncertainty either way, without guesswork. Step 5. Free, immediate, available right now. Pull up your most recent pay stub. Find the line that says, Federal Income Tax Withheld. Just look at it. That's it. That's the whole first step. You now know exactly what that line is, where it came from, and what you're allowed to do about it. None of this is about paying less than you owe. It's about knowing precisely when you're paying it and refusing to let a mechanism built in a wartime hearing room decide that for you by default, out of habit, unexamined. There is nothing radical in any of this. Every one of these 5 steps already exists inside the system Ruml built. None of them require lawyers, accountants, or special access. They require only the willingness to open a form you've probably never opened and ask a question you've probably never asked. Does this number still reflect my actual life? For most people, the honest answer is that it reflects a decision made once, years ago, and quietly renewed by default ever since. Changing it costs nothing but a few minutes of attention. The one resource this entire mechanism was designed to make you stop spending on your own paycheck. Understanding a system is not the same as resenting it. It's the first form of leverage anyone ever has. None of these steps ask you to distrust the government or to treat withholding as an enemy. The mechanism itself isn't the problem. It's arguably the reason the modern income tax survives contact with an economy of hundreds of millions of paychecks at all. The problem was only ever the silence around it. 83 years of a system running quietly enough that most people never learned its name, its origin, or the fact that it was, at every step, a choice made by specific people in a specific hearing room for specific reasons that had as much to do with psychology as with revenue. Leverage, not resentment. Hold on to that word, because it's about to catch up with everything you've heard tonight. The man on the radio in January 1943, Beardsley Ruml, really did tell Congress a secret about your money, and it worked exactly the way he said it would. The historical record shows he was right, and he was right about something else too. You stopped noticing it was gone. Withholding still runs unchanged in principle in every American paycheck today. Quiet enough that most people never think to ask where it came from. The woman who called her refund a bonus, that was Maria, 34, at her kitchen table this past March. It wasn't a bonus. It was her own $3,090, finally coming home months late, with nothing earned on the wait. And the man who started it all, the nobody who walked into the United States Senate and rewrote how 150 million Americans would feel about their own paychecks. That was Ruml too. Chairman of the New York Fed, treasurer of Macy's, barely remembered, permanently consequential. Understanding where a system came from doesn't just explain your paycheck. It's how you stop mistaking a habit for a law of nature, and that more than any refund is worth having. If tracing the hidden architecture of financial history like this is useful to you, consider subscribing. There's a lot more buried ledger to dig up. So, are refunds actually good news, or did we all just get played for 80 years? Let us know what you think in the comments.